Move over, PIMCO. There are some new whales in the bond market. Apple, Oracle, Google, and a few other cash-rich tech companies are now some of the biggest buyers of corporate debt. Bloomberg's Nabila Ahmed, and she followed the money all the way to Reno, as it turns out. JPMorgan Asset Management's Bob Michele, who's a bit of a corporate bond buyer himself, is with us here. Nabila, tell us, what did you find?
Well, there's a new king in the bond market, and he wears an Apple Watch and a Google Glass, and he hangs out in Reno. Apple and Oracle have both got their cash management units in Reno. They've got so much cash that they can't bring back into the US for tax reasons, so they're investing in the corporate bond market.
Bob, what does that mean to you? You're one of the biggest players in corporates. When Tim Cook and all that dough come and knock in, what does it do to liquidity? Can you feel a difference?
You can certainly feel a difference. Every time there's a little bit of a backup in yields, a little widening of spread, these big pools of capital come in, and they're not only the central banks printing money. They are in the tech, they are in the pharma industry. These are in these cash flow rich companies that have little capital expect.
How does that, what kind of a structural impact does that have on the bond market? Because there have been big corporate buyers of bonds before, insurance companies. But now that you have these new entrants spending hundreds of billions of dollars that just weren't there before.
I actually think it adds a much-needed stabilizing force. To some extent, we spent a lot of time looking at the decline in liquidity, that broker-dealer balance sheets have shrunk, that they can't give us the counterparty exposure that we once could access. But the reality is the corporate bond balance sheet now resides within the buy side. Investors like us dominate that market. So when we have needs to invest, it's nice to know that there are other counterparties out there with similar needs or potentially selling.
What happens, though, when rates go up and they can get back into cash or US Treasuries? They don't need to be in corporate bonds anymore.
Well, corporate bonds should still be yielding a bit more than cash, and most of them are carrying them on amortized book cost. So it's a very different dynamic. My guess is that they're not going to be sellers. They have new cash coming in all the time. They may let that accumulate in liquidity funds and let their bond portfolios run off.
All right, Bob, we thank you once again.
Thank you so
Bob Michele,
Thank you.
Chief Investment Officer for Global Fixed Income at JPMorgan Asset Management. Bloomberg's Nabila Ahmed also here. Thank you, Nabila.
Nice to be
Great
here.
story.